Okay, a few things we need to be reminded about with regard to investment. The word appreciation. Appreciation is an increase in value due to market conditions. The appreciation in value might be temporary, it might be permanent. Only thing you need to know is that appreciation is an increase in value. A real estate broker may need to know the basics of calculating an investment, but the broker should always advise the client to consult a CPA or investment counselor for a professional estimate of property appreciation. Real estate licensees are in the business of selling real estate and writing contracts. They are not in the business of financial counseling. So we don't want to financially counsel a client. We want to refer the client to a CPA for that. To find the change in value, here's what we do. We take the new value, which is the listing or sales price, minus the old value, which was the original purchase price, and we come up with the change in value. For example, the change in value equals $250,000 minus $200,000, which equals $50,000. Thus, we have an appreciation of 25%. So appreciation is the change in value. To calculate future value of a property, we find the current appreciation rate in the neighborhood or city, and then we find the future growth factor. Future growth equals 1 plus the average annual appreciation rate times the number of years a purchaser or owner plans to hold on to the investment. For example, the average appreciation rate in City A is 6%, and the investment will be sold in 10 years. The future growth factor will be 1.79, and here's how we find it. Future growth equals 1 plus 0.06, which is 6%, times 10. Future growth equals 1.79. Depreciation, as it's used in the cost approach in valuation method, depreciation, as it's used in the cost approach valuation method, is loss in value due to any cause or condition. For investment purposes, depreciation calculations are used to determine the loss in value of property for tax purposes. An investor always wants to take depreciation because they get a break in their taxes. Rental property owners use depreciation to deduct the purchase price and improvements from a tax return. Depreciation commences as soon as the property is available for use as a rental. Most U.S. residential property is depreciated at a rate of 3.636% each year for 27.5 years. 3.636% each year for 27.5 years. Only the value of the building is depreciated. Land is not depreciated for tax purposes, or ever for that matter. We don't depreciate land. Depreciation tables are available online for calculation purposes. An investment property depreciation calculation involves the following calculations. Purchase price minus land value equals building value. Building value divided by 27.5 equals annual allowable depreciation deduction. For example, assume the value of land on which a fourplex investment property is $90,000. The land is valued at $97, and the actual purchase price of the property is $350,000. The depreciation will be $9,455 a year because we take the value of the whole property, $350,000, minus $90,000 equals $260,000. The value of the whole property minus the value of the land equals the building value. Now we take the building value of $260,000 divided by 27.5 years, and we come up with $9,454.55. Rounded up, that's $9,455 per year in depreciation.